Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore, and in this video we will continue our deliberation on prior period errors as contemplated under Ind AS 8 or IAS 8. And now we will deep dive and look at another interesting part of the conversation wherein we need to find out whether the prior period error which we saw in the earlier video, whether all such prior period error needs correction, or is there any leeway wherein the standard gives some relaxation. So let us see what type of prior period error need correction, whether all needs correction. Just a quick recap. We have already seen the definition of prior period error as given in paragraph 5 and in paragraph 41. What are the type of prior period errors which may creep into the financial statements. So just for continuity perspective, I have brought in the slide. Now let us look at the moot question which we are trying to deal in this particular video, whether all prior period errors need to be corrected. Now, so the first thing, before we get to the answer, let us look at what the standard is talking about this. Let us see what guidance is available in the standard, and then we will conclude whether all prior period errors need correction or not. So if you look at paragraph 41, which we saw in the earlier video as well, paragraph 41 of Ind AS 8 or IAS 8, it says, the circumstances in which financial statements will not comply with Ind AS or IFRS as the case may be. If you are dealing with Ind AS 8, when the financial statement will not be deemed to comply with the requirements of Ind AS, when, if you see here, there are two circumstances. So, paragraph 41 of Ind AS 8 or paragraph 41 of IAS 8 contains the same provision wherein it says financial statements do not comply with the requirements of Ind AS or IAS or IFRS as the case may be if they contain material errors or they have immaterial errors which have been made intentionally to achieve a particular presentation of the entity's financial position, financial performance, or cash flow. So there are two legs of the definition. The first leg says that the financial statement will not comply with the requirements of IFRS and Ind AS if they contain material error. That means materiality is important. That is one leg of the definition. Or even if the error is not material, but if you have done those error intentionally to achieve a particular outcome related to a position in the balance sheet, in the P&L, or in the cash flow, then even if that amount is immaterial, that error is immaterial, but because there is a conscious thought process around it, that will still be classified as the error because of which financial statements do not comply with Ind AS or IFRS as the case may be. Now, since this paragraph uses the word material, it is important for us to understand what is materiality and how do we assess it. If you look at on the right hand side, materiality as a concept is not defined in IAS 8 or Ind AS 8. It is not defined. It is actually dealt with in Ind AS 1. So materiality as a concept is defined in Ind AS 1. However, this IAS 8 or Ind AS 8 in paragraph 5, it does a cross-referencing to IAS 1 or Ind AS 1 about the concept of materialities. Therefore, when we say here, if materiality, when you are assessing materiality of the error, you have to actually refer back to Ind AS 1 or IAS 1. Because paragraph 5 of this standard refers you back to IAS 1 or Ind AS 1 for the purpose of determining whether it is a material item or not. Now, therefore, now let us see how materiality is defined in Ind AS 1 or IAS 1. Let us see this at the bottom. So a combined reading of paragraph 7 of Ind AS 1 and paragraph 5 of Ind AS 8, whenever you see an expression like this, Whatever is after decimal is the para number. So you should read it here, paragraph 7 of Ind AS 1 and paragraph 5 of Ind AS 8. So a combined reading of these two paragraphs says that an error is material if omitting, misstating, or obscuring that could reasonably be expected to influence the economic decisions of the primary users of the financial statements who take such decision on the basis of those financial statements which carried these type of errors. That means you have omitted something, you have misstated something, or you have obscured something in those financial statements, and the users, the primary users of the financial statements, like your investors, your creditors, your vendors, those broad categories of stakeholders, they are making economic decisions, and those economic decisions get impacted because of these omission, misstatement, or obscuring of of such items. Also, if you look at paragraph 7 of Ind AS 1, it further tells you, when we say obscuring, what does it mean? Obscuring means something you are hiding. So a further clarification is given in paragraph 7 of Ind AS 1, which says, when you will say that something has been obscured, it says information is considered to be obscured if the information is communicated in such a way which has the same effect of either omitting or misstating that information for the primary users of the financial statement. Thereby meaning that if you obscure or hide the information in such a way that the effect of such obscuring is similar to either omitting or misstating the financial information, then that would be considered as obscuring. This is an additional guidance given in paragraph 7 of Ind AS 1. Now, further, paragraph 7 of Ind AS 1 gives you additional guidance, and it says the standard goes on to observe that materiality, which we are looking at here, materiality depends on the nature of or magnitude of the information. What is the nature of information involved, which is subject matter of error? What is the magnitude of the information, which is subject matter of error, or both the nature and the magnitude? Therefore, an entity assesses whether the information is material or not in the context of its financial statements taken as a whole. And I'll give you one case study to explain this as well, either individually or in combination with other information. So, this is very, very important guidance given in paragraph 7 of Ind AS 1. First, it defines what is material. An error will be material if it impacts the economic decision making of the primary users of financial statements. It has explained what is the meaning of obscuring, and it says that when you are assessing materiality, assess by looking at the financial statements as a whole, not the parts of the financial statement. Therefore, if you sum up all of that, this is what you have to look at. So, materiality is the key. Therefore, not all prior period errors need to be corrected. Generally, only those prior period errors will need to be corrected which are material in nature. Of course, unless you have done the error by conscious design. So, not all prior period errors need to be corrected. That is the first answer which you are getting. Should you correct all of those errors? No, unless and until you fall into the second category where you are intentionally created errors. If that is not the case, not all errors need to be corrected. Ind AS 8 requires correction of only material prior period errors and materiality as defined in paragraph 7 of Ind AS 1. And as we have seen that here additional guidance is given that materiality is to be judged in the context of whether that error could influence the decision of the users of the financial statements. So, in sum and substance, this is the moot point which you need to understand to get an answer to this. Also, when it comes to immaterial prior period errors do not need retrospective correction unless you fall in this second category. Because those immaterial ones which have not been consciously done are not significant enough that would impact the economic decision making of the users of the financial statement. And therefore, if you have immaterial prior period errors which are not by conscious design, then you can correct such immaterial prior period errors can typically be corrected even in the current period. You don't have to go back in time and do the retrospective correction of those errors without revisiting prior period financial statements. This is the sum and substance of the answer to this question, whether all prior period errors need correction. In general, no. And this is the answer which you should look for. This portion which I just highlighted give answer to your question. And why this is? Because of the requirements, as we saw, is given in paragraph 7 of Ind AS 1, read with paragraph 5 of Ind AS 8, and of course, paragraph 41, which we have seen in the last couple of slides as well. Okay, so this is how you have to look at for this particular answer. Now, also, paragraph 7 of Ind AS 1 also gives you illustrative circumstances. If you look at paragraph 7, it gives you illustrative circumstances, examples of circumstances that may result in material information being obscured. When we talked about you are obscuring means you are hiding something which has the same effect of either omitting something or giving something in a wrong way, misstatement. So if you see, there are 5 such examples listed here, which is given in paragraph 7 of Ind AS 1, which says that in these circumstances, this will result in that material information has been obscured by the entity. So, first example is information regarding a material item, an item or transaction or an event which is material. You have disclosed it in the financial statement, but the language which you have used for the disclosure is vague or unclear. So thus, yes, you have disclosed the material item, you have disclosed, but the disclosure is not appropriate. You have used a vague or an unclear language. Likewise, information regarding a material item which is scattered throughout the financial statement. So if you have a financial statement running into 70 pages, now one part of the information you give on page 1, then page 20, page 32, 48, it is scattered, and therefore the users are not able to really make a sense out of the combined picture or the holistic picture. This is second point. So information regarding material item which is scattered throughout the financial statements, they are not given in a way which makes sense for the readers of the financial statement. So the first 2 points are for the material items which have been disclosed but not properly, vague, or it is scattered. The third one, you have dissimilar items which are dissimilar in nature, have been inappropriately aggregated. So you have, let us say, rental income, then you have finance expense, and let's say you have some kind of a miscellaneous expenses. You have clubbed them all together. You have aggregated. So they are dissimilar nature of transactions. But if you have inappropriately aggregated and shown them as together, that will be an example of that you are obscuring the information. In contrast, you have similar items, but you have disaggregated. So if you have 3 categories of interest expense, which ideally falls within the same category as a finance expense, but you have disaggregated them and shown it at a disaggregated level, that would be falling into this 4th category. And the last one is the understandability of the financial statement is reduced on account of material information being hidden by immaterial information to the extent that the primary user of the financial statement is unable to understand what information is material. What does it mean? It simply means that you are giving some material information, but you are giving so much of the irrelevant information that the users are not able to properly make out what is right, what is material. So you are giving information in such a way that you have material information and you have immaterial information, and you are giving in such a way that actually people are confused. They do not able to conclude that which information is really material. Though these are the examples which are specifically given in paragraph 7 of Ind AS 1 of these circumstances. So if you look at and summarize one more time, paragraph 31 of Ind AS 1 or IAS 1 would say, practically, when you apply the concept of materiality, what is the key takeaway you should take is this: that a specific disclosure which is required by a IAS or an Ind AS to be given in the financial statements or in the notes need not be provided if the information resulting from the disclosure is not material, even if the relevant Ind AS or AS, or rather the IAS, contains a list of specific disclosure requirements and describes them as minimum requirement. What does it mean? Paragraph 31 explains, okay, you have a particular scenario wherein a particular standard, let's say Ind AS 16, it requires you to give certain disclosures. It requires you to give certain specific disclosures. And they say it's a minimum disclosure requirement. But in your case, if those are not material, you should not provide them. That is the sum and substance of paragraph 31, because it says a specific disclosure to be given in the financial statement need not be provided if that information or that disclosure regarding that information is not material. That is one part. Secondly, likewise, an entity should consider providing additional disclosure even if not required. So an entity should consider providing additional disclosures when compliance with the specific requirements in Ind AS is insufficient to enable the users of the financial statements to understand the impact of these particular transactions. If this is a scenario, then this way you should also apply the concept of materiality. Now, one important point you should also understand that we said that yes, if the information is not material or the disclosure is not material, you need not give it. But there is one exception to that. If you see at the bottom, we are saying, except when required by law. But if your law says, let us say you have Schedule 3, and that requires certain disclosures. If the law says that the disclosure is to be given, then that requirement of the law is something which you need to abide by, and then in that case, you will not skip giving those disclosures. That's the way you have to read and understand the concept of materiality when it comes to Ind AS 8, when we are looking at whether material items or the errors have happened or not. Let us see a case study in the next slide, and then we will conclude our deliberation for this particular video. Case study dealing with determining the materiality of prior period errors. So let's see here. Consider a scenario wherein in respect of City Corp, wherein the following errors, these three errors have happened in the preparation of the entity's financial statements for the immediately preceding financial year. So you are in the current year. In the last year, these three errors have happened. What are the errors? Let us see one by one. So depreciation on plant and machinery was understated. It was lower by 0.3% of sales. Warranty provision was understated. Again, 0.15% of sales. And bad debts provision, allowance for bad debts, was again understated by 0.25% of sales. Now, if you see this is what the facts is given. This is very important point of consideration. Wherein this case study says individually each of these items are not significant. Individually, none of the above three errors is material, but could potentially impact the economic decisions of the users if you look at them collectively. If you read all the three errors together, then they can potentially impact the economic decision of the users of the financial statements, though individually they are not significant. That's why these 3 errors have happened in this year. Individually, they are not material, but collectively, they are material because they may impact the decision-making process of the users of the financial statement. So the question is, are there material prior period errors? Yes, we have seen that. That materiality, we have seen. There is a specific guidance in paragraph 7 of Ind AS 1 where it says materiality has to be assessed by looking at the financial statement as a whole, which impacts the decision-making process of the users of the financial statements. Paragraph 7 of Ind AS 1, paragraph 5 of Ind AS 8, and paragraph 7 additional guidance of IAS 1 or Ind AS 1. If you read it all collectively in this particular fact pattern, yes, individually these errors are not significant, but they are material because on a collective basis, they are likely to impact the economic decision-making process of the users of the financial statements. So I'll take a pause and we'll conclude this particular video. But just to give you a heads up, in the next video in this series, we will see two videos we have looked at. First, what is the meaning of prior period errors? Then here we have seen whether all prior period errors need to be corrected. Now we will logically progress to another important question, which is this. Okay, let us say there is a material prior period error like this, what we have seen here. Then what is the point in time when and how to correct the prior period errors? So if you have these kind of a material prior period errors, which actually needs your attention, then when you should correct it and how you should correct it, these two aspects is something which we will deal in the next section of our discussion in the next week's video. And there I will give you not only the requirements of the standard, but also few case studies to explain when and how to correct prior period error. But this is what I wanted to cover for this particular video. I'll take a pause. Here are my contact details. This is the link of my YouTube channel, and this is the LinkedIn page, my profile. Please connect with me. Do subscribe to the YouTube channel. And of course, if you feel that these contents are useful for anyone, do share them. Comment in case you need any specific topic to be dealt with from your perspective. I will certainly try to come up with a video on that topic as well to the extent I can. Okay, so that's what I wanted to cover, and bye for now. Take care. Thank you.